You know why we are here today? I tell you that every time I think of going into a seminar on Saturday, I'm waiting for clients' questions. And it's just such a coincidence. I was thinking of today, let's talk about selling business property. A lot of times we have business owners not quite sure whether the thing they're selling is business property or not, because somehow they hear the term of personal property. So they're getting that concept a little confused. So I want to clarify that for all of us today. And at the same time, just want to tell you that right before this webinar, I had a text from a client asking about selling business property, how much taxes is going to happen, and the things like that. So today's webinar is really to bring you that awareness, not to say that be able to calculate it for you, but at least you know that what is the selling price, and after you sell, and how much you really have it on your hand, instead of thinking, oh, that selling price is what the money I'm getting. Not really, right? So that is where we're going today, and we want to educate you. And I am learning while I'm educating you of what is all involved when we sell business property. So now let's look at this page you have right here with me, communitycpa.com. That is our firm's website. If you look at that blue button on the kind of in the middle of the screen I pointed to, and that's our onboarding with us button. What you do is, if you're not our client, you just didn't have time to call us during the day because you're a business owner. That's why we know you are that way. And you can click this button, and it just on the very bottom of that, and you sign in. You give yourself username, password. Then you can start uploading your documentation that you want us to see, whether that's a letter or it's a tax return, whatever that may be. You upload is a secure upload. What we do is, on our side, we actually see those new documents coming in, and we'll know that's you. We'll be calling you back, so make appointment and get on your calendar and things like that, right? So just understand our onboarding button is for that. Then, of course, the rest of the button is pretty clear what they are, and we have our website, and here is our YouTube channel. And you come over here, if you subscribe to this channel, what happened is when we have a new webinar, it will show you on your email. You get notification. You say, hey, today we're going to talk about tax consequences of selling business properties. Interested? Then you will come on. But if you are interested but has no time, 3 o'clock it is your fun time with your kid, that's fine. And then you can come over here at YouTube channel to see our all of our webinars that we deposit them here. So there's no way you cannot find it. You can come to this magnifying glasses right here to type in what you're looking for, then all the videos will come up. And we're here for more than 4 years already. Over 1,100 videos are accumulated in there. And the tax knowledge does update from time to time. But a lot of principles and the general understandings and the tax code, they're 30, 15, 20 years old. So they are here to stay. So our webinar doesn't go outdate that much, and you want to pay attention to the time mark. And if it is pandemic related, they do go outdate, right? Because we're out of pandemic time. All right, so what I will do now, and let me share my screen with you so that we can go to the real content I brought to you today. Tax consequences of selling business property. And my name is Ying. I am the managing partner for Community CPA. I started the firm back in 1998. So calculating forward, we're about 27 years in practice history. We have over 40 professionals working at our firm, 10 different languages collectively spoken at our firm. That tells you the diversity we have in our firm to provide the convenience to our client. We have over 12,000 clients worldwide as of today. We have 5 branches. Des Moines, Iowa City in Iowa, those 2 branches. Bloomington, Minnesota, Capitola, California, and also Houston, Texas being our newest branch came up this year. So I myself, I'm the CEO and managing partner. I served at the Federal Advisory Committee that provides advices to IRS for 3 years. So, high bullet point, just to give you a understanding of who we are. And of course, I'm also a author, and a lot of people knows my book. It is 2 books on Amazon right now, 8 a.m. and 10 a.m. I am working on 2 p.m. and 6 p.m. So 2 more books in this appointment with Ying series, and we're talking about business, how to start business, how to grow, how to expand, and also how to retire. And not really retire, right? Repurpose of your life. And who retires when you do something you love to do, right? That's really true. And I find a lot of people are feeling that way. And I actually find a lot of people after if they worked in the business for a very long time, they retire, they suddenly kind of lost of what they want to do. And those are the folks that you want to pick up this book just to start a business. I mean, life never ends. You think that you're in your 60s is end of the dawn. No, it is beginning of a new life, right? So that's how I view life. And my book reflects that. And you want to follow me on my writing journey. And I don't write sophisticatedly because my English is really subpar. I'm always getting corrected by my kids and my husband, so they like to pick on my English, and I just never felt I could really do it. But so far so good. My clients are not complaining, so I'm good. With that, and no responsibility disclaimer, so just in case I speak Chinglish, you're still okay, right? So that's the disclaimer is all about. Just kidding. And it's just a place where we say that whatever you learn on the internet, and just don't take it blindly and really place your judgment, right? And even what I said may not be right. I mean, I catch myself saying something incomplete, and that could be interpreted to a different meaning. Then I correct myself, but if I didn't catch myself, then that could be understood differently. So just be responsible for what you do to your tax and your finance, right? All right, let's just talk about what is business property. Business property refers to asset used for commercial purposes and generating profit as a reason to use it. So business property, as soon as you put in the word as a property, they're not a business expense, right? Business expense like utility, rent, and things like that. But business property are your equipment, are your vehicles, and your buildings and things like that. So there's 2 big types of business property. We're going to cover both today. One is real estate, right? They are buildings. They include business buildings, retail space, warehouse, and industry facility, multifamily housing buildings as a rental property, right? So those are real estate. They are literally houses or buildings that you see. The other big type is personal properties. See, I listed here for you because I don't want you to relate personal properties as to say, oh, mine. Personal property. No. Personal property is a type of property where it can move or can be owned by the person. It's movable things. It is not like the house. Well, who knows? In 10 years or even 5 years, these little houses that become personal properties too, because they're like a big module on Lego. You stuck 3 of them together, it's a house, right? So those concepts will change with application of the real industry and the real business world. But for right now, I want you to understand personal property in business just means equipment, machinery used in business, vehicle, and for business purposes, inventory, supplies, intangible assets like trademarks, copyrights. These are personal properties. They're business property. All right? So we are talking about selling those properties. If you sell this property for $100, do you have $100 in your hand? Or you actually have less? What would be a contributing factor to reduce that sales you got? And if you're selling a property to help you with cash flow shortage, and you can overlooking those necessary expenses related to the selling, and you may not get what you think you're getting. So that's important for you to have that concept. That's why we are here today, right? Selling, before I do business property and looking at that real estate, and I want to make a clarification between selling primary residence versus selling business real estate. And your rental property is business real estate, I want you to know. So quickly, selling primary residence is the one that at least 2 out of the last 5 years you were living there. See, I really want you to remember that is 2 out of the last 5 years. So last 5 years, you lived there for 2 years, but you rented for 3 years. So do you still have this exclusion? What is the exclusion? What it says is that if you sell your property for $1 million, and this $1 million, after reducing the basis of the house, and you got a $500,000 gain. If it is your primary residence, if it is you and your spouse living together in that primary residence, then you walk away from capital gain. That $500,000 gain you got, the million minus 500,000 was your purchase price in the past, so you got a gain of 500,000. That is free of tax, right? And the state normally follow the federal on the primary residence exclusion, so they don't go ahead charge you for that. So you walk away from tax, both federal and the state. And the way you calculate gain is very simple. You do sales price minus base of the house, then you got the gain. The gain, if it is not over 500,000 for married couple, and then you walk away for free. But if you have a loss on your primary residence, you cannot deduct it. You cannot deduct that losses with your W-2. But in business, if it is a business property, the loss can be deducted. So that is a main difference here. So I want to just point out, because I know all of you understand this one, but let's separating the business property versus this one we're talking about. So selling commercial real estate. When selling commercial real estate for a gain, there's several tax implications. Okay, so I kind of listed by the highlighted one. Of course, the number one is capital gain, because you're selling for a gain, so you're going to be subject to capital gain. Then you also have, this is what we called Section 1250 recapture gain. So I'll explain that. Let's look at the capital gain. So if the property is held for 1 year or less, the gain is considered short-term and taxed at an ordinary income tax rate, which range from 10 to 37.5, depending on your income level. So if you are not holding your commercial property long enough, you just pay regular income tax on the gain. And if it is long-term capital gain, of course means the property is held for more than 1 year, and the gain is considered long-term, is taxed at a lower rate, typically 0, 15, 20, depending on your taxable income. So the maximum is what? 20%. All right. So that's the capital gain. So it didn't have the exclusion anymore, right? Because it's commercial, because you are renting it out. So it's not your primary residence. So what about this depreciation recapture, section 1250? Are you folks will say that don't talk code, we don't like it. Just want simple things to you can tell us. When you sell a commercial property, you may have to pay taxes on the depreciation deduction that you took over the time you own that property. You remember, right, when you bought the property and then your tax accountant was doing depreciation for your property. Those deduction at that time now come back to you. That's why it's called a recapture. It's a recapture gain. So that typically you deal with the property, and especially you deal with the property especially when you owe it for a long time, because you would need to go back to calculate those depreciations, then figure out how much taxes you need to pay, and those gains are taxed on the regular income tax rate. They are recapture gains. Okay, and the state tax is another one to consider. When you sell commercial properties, and it is not like the primary residence, those exclusions, the state are also taking it. The state are endorsing the federal exclusion, say we don't tax that either, so you walk away for free. But based on each state's rule, and you may also be subject to state capital gain tax. Okay, later on in my slides, I'll talk about the state. So basically, your commercial real estate property, when you sell, the cash you got onto your hand, that equals to sales price minus loan you're going to pay out, minus your selling expenses, minus your capital gain taxes, minus your 1250 gain taxes on recapture gain, and minus state tax. See, this is where I tell our small business owner that when you are thinking of, oh, I'm going to sell this property to help me with cash flow, is it really helping? And you need to minus all of these things before to look at what's in your hand can be the money to help you for cash shortfall, right? This is where we come around and talk to you about these seemingly simple concept. Well, I sell a property, I got money, well, so what? So what? Because there is taxes related to that. Capital gain tax, recapture tax, and the state tax. All right, what else? You may say that, okay, now I know this, so what's the idea you have to reduce some of those gains or reduce all the gains? So I do have some ideas to share with you. Of course, you heard of the 1031 exchange, also known as a like-kind exchange, right? Allow you to defer capital gain taxes by reinvesting, repurchase, okay, another property, similar property. The capital gain you made on selling the property A went into property B, and that deferral can continue indefinitely as long as it's reinvested in the property and that property didn't sell, or we can sell the property B again, reinvest in the even bigger property. So you can do that so you don't pay capital gain. Investing in qualified opportunity zone can also provide significant tax benefit. I want to bring this concept to you because not a lot of small business owners are really paid attention to this. If you reinvest the capital gain you got out of your selling of the property into this kind of area, you can defer taxes and potentially reduce liabilities for a certain period of time. So I just want to kind of give you an idea of what are these. I'm using this big word, QOZ, and what are these qualified opportunity zones? So In California, there are 879 designated opportunity zones. In Minnesota, there are 128. In Iowa, there's 62. And I pull out two cities that Des Moines, I literally live here a lot of times. And the Mason City, when I go to Bloomington branch, I pass by that place all the time. And so we also have a lot of clients from there. Mason City, Iowa has a designated opportunity zone that spans from approximately 4th Street Northwest to the city's southern limit at 230th Street. People who live there know exactly what I'm talking about. So if you invest property in that area, you get a break on the capital gain tax. Des Moines, the same thing. City of Des Moines has 2 federally designated opportunity zones, and they all located close to Drake University area. Folks knows what I'm talking about if you live here. Okay, so those are the opportunities to help you to kind of get away or reduce your gain tax, right? And certain expenses related to sale, such as real estate commission, legal fees, closing fees, and that can also be deducted from your gain. So that's why when you look at my formula from the last one, and I said that you're selling on the bottom of there, selling expenses, that's where you deduct all of these fees to know what's actually part of the cash on hand calculation, but that fee also directly reduce your gain, so you don't pay so much taxes on that. All right, so this is how to reduce real estate selling gains. And now we kind of conclude the section where we talk about real estate, right? Remember, business property including 2 big areas. One is business real estate, commercial real estate. The other one is called business personal property. Remember we had the slides earlier, and then the business personal properties are equipment, machinery, things in that nature. Okay, so now I want you to think with me. We are talking about personal properties, in business personal properties, and see how, when we sell them, what kind of things we need to know. When you sell business personal properties, and you will encounter net gain and net loss. And the difference between when you sell primary residence, remember, if you have a loss, can you deduct it? No, right? But what if you sell a business personal property and you have a loss, and that loss is go directly reduce your income? So yes, you can deduct that. The net gain though, if you have the gain, if the netting of the gain and loss from the sales of business property result in a gain, in a net gain, then it generally qualifies for a long-term capital gain treatment, right? Generally qualifies for long-term. Of course, if you have an item you held less than 1 year and it doesn't, and it is typically more favorable than ordinary income treatment due to the lower tax rate, right? So when you sell your business personal properties, the gains are subject to capital gain, and it could be long-term, could be short-term, and then if it is a loss, and then you can deduct it. So that is kind of where you sit on the selling gain and loss. What about recapture rules? Remember we talked about in the commercial property, we talk about recapture rule, but you remember when we were talking about primary residence, we didn't even mention about that. Why? Because you don't depreciate your personal property, remember? All you do is on Schedule A, you claim property tax, you claim mortgage interest. What else you do? You don't do anything. You didn't really deduct depreciation. That's why in the primary residence, there's no recapture, so-called recapture rules doesn't apply. But in commercial property, the Section 1250 is the recapture rule. So that is what's subject to the selling of commercial property. Sometimes I recall there were a couple of times my client would call me and goes, I'm going to sell this property. Can you tell me what is my recapture gain? That was so amazing because this client not only understand capital gain and loss, and he also understand recapture gain and loss, and he is recapture gain. So he's calling me to figure out what is the recapture gain. So that's a deeper understanding. I would call it, business school graduated, right? Not like some folks, and when you do business side of transaction and you totally don't consider recapture rules, that would be a loss because you'll be suddenly realize, what do you mean I have to pay so much tax? I didn't even make much. Yeah, you didn't make much capital gain, but you made much on the recapture because you had the business, you had the property for a long time and you deduct the whole thing already, so we're going to recapture the whole thing, right? So now, under the personal property, under business personal property, the recapture rules, and you will come across 3 of them. One of them is general capture. The other one is 1245 and 1250. 1250 is also related to buildings and the building structure components. So it's, when you buy a building and a part of the building, building depreciation is different. So part of the depreciation, it would subject to 1250, and some part of it would even go to 1245. So these are separated by the classification and by the categories where you put the business properties. That's why when you sell your business property, and to put them in the proper categories is actually very important too, for seller and buyer, for both of you. So that's why you need to negotiate. Both seller and buyer need to agree. This purchase I buy, or this sell I make, and what is what. Which part is the personal property, which part is the commercial property, or which part is intangible, which part is tangible. Of course, intangible also belongs to personal properties. So now, general recapture. If you have had a business property, net loss within the previous 5 years, like 5 years ago, any current net gain may be treated as an ordinary income instead of a long-term capital gain. So that's our general recapture. Basically, for my followers on YouTube, don't get into too technical. Just remember, if you have carryover losses, and these recaptures will apply to your losses first. Then you have Section 1245 property. These include depreciable personal property. Gain on sales of Section 1245 property are recaptured as ordinary income to the extent of previous depreciation deduction. It won't be more than depreciation deduction that you has done in the past, but all of them came out as ordinary income. Why do we care about capital gain, ordinary income? And because capital gain, generally speaking, enjoys a lower tax rate. Ordinary income, that just depends on where you are on your tax bracket, right? You could go as big as 37.5%, and plus the 3.8, so we're talking about 40-some%. So then Section 1250 property, this generally includes buildings and structure components for property placed in service after 1986. There in tax laws, some sections they will give you this year and that year. The way I try to remember those years, I always try to figure out anybody I knew was actually born in those time, in that year. That gives me a better remembering of what year is the cutoff. So, there is a lot of different time period. They're doing different treatment. So the way, that's how I remember those things. And those gains attributable to the depreciation deductions they are taxed at a maximum rate of 28 25.8%. Actually, this is the 25% maximum plus 3.8%. That's why we have 28 with that. The 23.8% for long term, that one just gives you the 20% in long term rate. You remember that's 20% maximum long term capital gain tax rate plus the 3.8 net investment income tax. That was imposed during President Obama's time. So those are new tax for the gain. All right, so selling business property, personal properties. So we talk about recapture rules, we talk about gain. If you don't remember all of these details, I want you to realize that as long as you have a gain and then you are dealing with the capital gain or you're dealing with regular income tax gain, and on top of that, and you have a recapture that you may or may not know how to calculate. So this is where you want to go for professional calculation. Go back to your tax preparer and they would be able to add it up and calculate it for you, because assume you have all the tax returns from the past, right? All right, selling business personal properties, allocating the sales price, and I mentioned a little bit, allocating sales price is a negotiation. The allocation often is a point of negotiation between the two parties because the tax liability is just not the same. Let me give you an idea. Let's say if I am selling to you a business, and I say that I'm selling it to you for $100. So out of the $100, I tell you that 100% of my $100 is actually goodwill because I build my name, and 100% is my goodwill. And what happened to me is when I say that, then that $100 is capital gain because my base is zero. I made $100 goodwill, so it's capital gain. And it's a long term because I was running business for more than 1 year. But for the buyer, the $100, if it is a goodwill, they can't really deduct it. They become a capital asset. It is a goodwill. And so what they want to see, they want to deduct it. So they rather say that, no, it is not goodwill. It is actually that stovetop, and that itself is $100. And you have already used it for 20 years, so I am buying it for $100. I can depreciate that. Why do they want to depreciate? Because they have expenses over the $100. They can write off the $100 right away, right? So that's why the negotiation of the sales price is very important. Just depends on whether you are a salesperson, you are selling, or you are buying. And a lot of times as a CPA, and I always tell folks that when you sell business property, you come to CPA. You come to your accountant. And we actually can have this understanding and a plan for both buyer and seller, so you come to a mutual agreement and both of you benefit from the tax treatment. But if you go into a litigation with the attorney, remember the attorney will never be able to represent both sides. So they will make one side win more, the other side lose more, right? So with that saying, and when you are dealing with business kind of negotiation, a lot of time the best place to go is not the attorney firms, it is the CPA place. Because you just want to calculate the bottom line. And we can even tell you how much legal cost is gonna be, so you know exactly you come out better or you come out less, right? So this is where I say that the allocation of sales price, I know the deal might be negotiated by the attorney, but how you want to treat it, what you're gonna allocate to your asset, that is a science handled by CPAs, by people who actually understand depreciation, understand recapture rules, understand capital gains long-term and short-term. With that said, you want to know that it is not just you say, oh, I sell for $100,000, end of the game. No. In that sales contract, I need to categorize where that $100,000 allocated to. Are you selling what? You're selling a vehicle and a plus couple desks and then a client list. What are you selling, right? These are important tax implications. It's not something you just want to waste more money with your lawyers because they need to actually give you that consideration on tax side of the deal. Selling, the deal structure, of course, other than the selling price, you need to allocate. And then also how you receive that money is another negotiation that need to be done because that one need to consider what's your need on the cash flow side. So you structure the sales, right? Whether you want to get them by installment or you want to get them right away, and whether you want to sell them by asset or you sell by stock. So these are deal structure that also impact your cash flow. You know, I want to talk about the stock sales, which is aside from the asset. One earlier, the example I was talking about is more of an asset sales, right? You know, stovetop and chairs, you know, vehicles. I was talking about things. But what about you have a business and you want to sell the whole business and the stock sale? You want to give the stock, sell the stock to another person. So these are different cash flow projections when you are doing that. Installment, you understand, that just means that you don't get your money at once. You're going to be getting it by a period of time. Of course, it's risky. What if the person who bought your business or bought your property, you know, went belly up? Then you don't have your installment, right? So with that said, there's a lot of negotiation, and you know the sales price need to be broken down, and you also know that how you receive cash is also a tricky thing, and as well as whether you want to sell them as an asset or stock base. So let's talk about selling business on the stock base, on the stocks, because it is not the same as selling for asset. Of course, the reason we want to separate this for you, we want to talk about this, because the money you get onto your hand is different story when you sell business stock. So when selling stock in business, these are the couple of things you consider. Capital gain taxes, of course, and the basis calculation, and the most important one is this one. Qualified small business stock. Exclusion, gain exclusion. You could walk away from $10 million capital gain without paying taxes. Section 1202. Okay, and of course, you need to be aware of this net investment income, 3.8%. You know, President Obama's tax, right? And the state taxes. Many states impose their own capital gain taxes. So I will cover Iowa, Minnesota in the next two slides. But let's understand the selling business stock. So of course, capital gain. The profit from selling business stock is typically subject to capital gain tax, right? The rate depends on whether it's long-term or how long you hold the stock. So long-term capital gain, the stock held more than 1 year, generally taxed at the rate or 0%, 15 or 20, just depends on your other income, what level you are at. So maximum 20% long term. Short term, it is taxed as ordinary income. So ordinary tax rate. Of course, how do you calculate the basis? The taxable gain is calculated as the difference between the sales price minus your cost basis in the stock, right? So that basis is calculated to include your original purchase price plus any additional investment that you made. So where did you see those numbers? They are on your tax return. They're on your capital account calculation. If your tax return is done properly, you actually have a sheet that calculates your stock values on the annual basis when you file taxes. So IRS knows your basis. So you use that minus the sales price, you got your taxable gain. So what about this qualified small business stock exclusion? If the stock qualifies under Section 1202, then you may exclude up to 100% of gain from federal taxes. Of course, there are limitations. There are industry limitations. Certain industry cannot do. For example, the restaurant. The restaurant doesn't qualify for this 1202 treatment, right? So depends on what industry you're in. When you sell your business property, when you sell your business, and the Section 1202 should be automatic. You should think about that. You may not qualify, but that is something out there, and allow business owner to not pay taxes. Don't you want your sales minus your expenses, so that's all your money, you don't have taxes to deal with? Yeah, that would be wonderful. And what about the net investment income tax? I already mentioned that to you. The state taxes, let's look at Iowa. The state and the local tax need to be considered when we calculate our cash flow. When we know that, okay, I made a sale, how much do I keep in my pocket? Different states have different rules. In Iowa, there's specific provision for capital gain tax exclusions related to sale of business property. So Iowa capital gain tax is not cheap. It's 8.53%. It's actually higher than a lot of states. And here is the eligibility points. If you material participate and the holding period longer than 10 years, then when you sell your business property, that gain is exempted. And the type of sales. The exclusion applies to the sale of all or substantially all of the tangible personal properties or service of the business. And don't read personal property as something like your jewelries and things like that. No. Personal properties in business just means that the asset is actually movable and it can belong to an individual or an entity, right? An individual, in terms of the tax entity is individual. So then these are the definition for that. So all are substantially all. So if you sell your business out, or you sell substantially all of the service out, those gains, this means that the sale must involve a significant proportion of the business tangible asset, not just the ownership interest, right? So when you do that, when you have majority of your business tangible asset come along with the sales, and is exempted from capital gain, you walk away from 8.3% capital gain as long as you meet those criteria, which is 10 years, you have it for at least 10 years, and you material participate, and you sell all, substantially all, of the tangible business property. So that's Iowa. And when you are in business in Iowa, and when you calculate your sale, and if you meet this criteria, you don't have to calculate the state tax side of impact for you, right? What about Minnesota? Minnesota generally do not offer a broad capital gain tax exclusion like Iowa do. And the state includes all net capital gains income in taxable income and is subjected to the same tax rate of other income. So these are rates in Minnesota. So all the way to 9.85%. Depends on your income level. And of course, Minnesota do recognize some federal exclusion, right? Like the primary residence exclusion. The Minnesota agrees with that. So when you sell houses in Minnesota, you exempt from federal and the state taxes. And they also, the Minnesota also goes with the federal qualified small business stock sales. Remember that slides we're talking about, right? So that Section 1202. So Minnesota also will agree with that. So if you don't pay taxes on your sale, on the federal sale, and then you don't pay taxes in Minnesota if it is the business, if it is qualified small business stock. All right. Last but not the least, I want to summarize right here. Before selling, calculate cash on hand. Okay? Before you sell, calculate cash on hand. Make sure that is really the cash you need. Okay? What is in your hand will not be, what is the selling price will not equal. It's not, may not. It's just not equal to what you have on your hand. So the cash on hand equals to sales price minus the basis, minus the loan payout, minus the selling expense, minus capital gain taxes and recapture taxes. That is your cash on hand. This is at very high level, right? You know, if you hear nothing out of this talk I have today, I just want you to remember this one. At high level, you sell. Of course, you can minus your purchase price from before. Then the rest of it, the selling expense, the capital gain, and the recapture is all coming in. So you need to know what that is. Once you look at the specific business property you want to sell and calculate to see whether the cash on hand would really meet your desire. Because I don't want you to go ahead and sell a business property prematurely and then you didn't get the cash you wanted, then what's the point, right? At least at this point, you know to pick up the phone, call community CPA before rush to sell. Then realize that, whoa, you know, the cash on hand is not what I expected. And you can go online to make appointment with us. You know that, right? You don't have to call and talk to someone. You can just go online to our website. These are the partners we have on this type of consultation. And I want you to contact me and Song Mo. And you see him on the fourth line. And two of us are very good with explaining to you about this. So I want you to know. And with my last slides for the day, folks, that is our YouTube channel. You want to subscribe to our channel, be always educated with what's going on. And I want to say that, you know, a lot of our clients, when they are in business, they have a huge advantage if they know a little deeper of what is all involved. And to know a little deeper of what is all involved, there's no tricks. I'm not sending you to PhD program at some college. You just come to Community CPA website, Community CPA YouTube channel, subscribe to our channel, listen to our talk, and we're not entertaining focused, but I try to at least give you the energy that so you can stay with me for this hour so you know, generally speaking, what I'm talking about. And we have our website, you know what they are, communitycpa.com. And we have Catherine at communitycpa.com. It's an email address we give out to everyone if you have a new topic you want us to talk about, or if you have questions you want to ask, and you can email. And call this number, 515-288-3188. And we open 6 days a week. You know, Saturday, I work on Saturday. I don't feel much of a loss just because we always have people work on Saturday. I'm so used to working on Saturday. My parents worked, when I was little, they were in China, so it's always 6 days a week, work day. And I didn't even know Saturday can be a day off until I arrived to Canada. And then Canadians work 7 hours a day. Do you know that? Not 8 hours. So when I immigrated to U.S., I'm like, what? I got 5 more hours to work in a week? Not worth it. No, it's worth it. The harder you work, the better you make it. So that's a general rule. So I hope to see you again. I hope you enjoy my webinar. See you again. Bye-bye.